Welcome. I'm Marco Lala, co-managing director of investment sales at RM Friedland, and I'm here with my daughter and colleague, real estate salesperson Michelle Lala, also from investment sales, to discuss the 2024 year-end investment sales market report for the Bronx and Northern Manhattan. In the Bronx particularly, which is what I'm going to be discussing today, we had approximately 250 some odd sales in the investment category. That translated to between $800 and $900 million worth of transactions. Average sales transaction was a little over $3 million. Now, half of that, almost $900 million, was multifamily, which is an area that we spend a lot of time on because of the amount of velocity in that submarket. The next categories would be basically industrial, mixed-use, office, and also development sites. Now, in the category of multifamily, there were a lot of challenges, including things like insurance costs, other operating costs that have affected values tremendously. Also, the rent law that was signed into effect in 2019, HSTPA, also had a tremendous effect on downward pressure on values due to the inability to raise rents in proportion to inflation and other cost factors in running an apartment building. Now, what's interesting is that with the three recent Fed rate cuts, the 10-year actually went up, which caused higher interest rates. So in an unusual phenomenon, that's actually now created more velocity year over year, particularly in the last quarter, because owners are starting to conclude that we're basically in a higher for longer situation. And what's happening there is instead of waiting for rates to come down, and if they do, they're going to be nominal decreases, maybe anywhere from 25 to 50 basis points. That could span over quite a while. So the strategy has to put into effect. Do I have a succession plan? Am I going to stay in the business? Am I going to work on my properties in order to maintain a longevity? So these are the things that a lot of Bronx owners, as well as mostly in the boroughs and in that genre of rent-stabilized product. Michelle's going to speak a little bit to the Northern Manhattan submarket. Michelle, can you give us a little insight on that?
When looking at the data in Northern Manhattan, the one thing that I noticed that was not surprising at all was that mixed use properties had a very strong year. And I believe, and from what I've noticed, is that a lot of investors are very attracted to mixed use properties because you're able to have a free market component as far as the residential part of it is concerned. The retail there, you're going to get higher rents. And even if you did have a vacancy in the retail, you'd be able to make up for that with the higher free market rents that you'd be able to get. Investors ask us for those kind of properties. I would say every day. I think we get requests for those every day. Multifamily actually had a great year. Volume was pretty high, and I believe that was because a lot of sellers had that epiphany that they'd be willing to meet the market. I mean, we could speak to that. We actually sold a multifamily property on West 204th Street in Manhattan for $79,000 a unit. We sold another property. What was the cap
rate on that? I think it was like over 9%. Too.
Around that cap. Yeah. And then we actually sold something on West 205th Street. The seller actually bought it in 2016 for $12.6 million, and we helped him sell it this year for $9 million. Right. So I think that had a lot to do with sellers finally coming to that realization where I have to meet the market if I want to sell this property. And I think that reflects in the numbers that we see in the report. Retail had a great year as well in Northern Manhattan. There weren't a lot of trades, but the properties that did trade, it was at far higher numbers than last year. And I believe that is because a lot of investors are a little bit put off by the multifamily market and the rent stabilization, and they don't necessarily want to deal with those residential tenants, and they much rather prefer to own retail in New York City rather than deal with the residential component of it.
It's funny how that turned because during COVID, commercial was basically decimated.
Absolutely.
It became toxic, and now it's kind of become like the flavor of the month.
Yeah.
Especially if you're in a strong retail corridor by a transit stop or a subway station. To illustrate, further illustrate the example that Michelle gave on the sale of $9 million that was recently purchased for 12.6 years prior. The one factor that allowed that to happen, though, was that the owner was very conservative all along in terms of his refis and even his acquisition financing. At times, he put down probably almost 50% on the acquisition, and then on the refis, never cashed out. Just actually kept lowering the tier of debt on the property, taking advantage of the lower interest rate, and then cash flowing. So, in an unusual twist, although it looked like a $3.6 million loss on paper, at least in terms of rationalizing the sale, he was cash flowing tremendously over 10 years because he never really pulled out on the financing side, but was able to get the rents up. A good portion of that was pre-rent law change, so he was able to accelerate the rent growth, and with the low debt and low interest rate, was able to cash flow double digits and really soften the blow of that realization of the $9 million sale. So that's kind of what we're seeing. The other sale on 204th at a 9 cap, that was just something that was in the family since the 1950s, again with probably less than 40% leverage on it. So even what sounded like tremendously low metrics or sales price and high cap rate, there was a cash flow situation. Now, Michelle mentioned free market. One of our recent sales was a 23-unit that was basically free market. It had a tax abatement that expired in 2016. That traded for a little over a 7 cap. Now, there's a nuance there with the free markets, as attractive as they are. If the property was built before, I believe it was 2019, you're now susceptible to the good cause eviction, which creates kind of a hybrid to the free market, almost becoming like rent stabilized. You have to renew the lease with the existing tenant, and at the same time, you're capped at 5% plus the CPI. So even though you have a free market unit, you can only re-rent the apartment to the existing tenant unless there's good cause to evict them, and cap the rents at now it's like 8.8 or almost 9%. So, but we go with the high density urban multifamily markets because that's where the trades are, and that's why we can come up with such granular reports. And we really hope you download these reports because we get into everything from price per unit, cap rates. We look at all the sales, and we break them down in tiers: low, middle, and high tier neighborhoods based on the sales prices and other demographics like area medium income and so forth. So, Michelle, I want to thank you so much for being part of the team and your contribution on the team. And can you just give us a little bit of, just to conclude, when you're calling on the phones, and let's keep it, PG in some of the responses. But like, what's the general sentiment are you seeing right now since we've had an election and we've had a pause in the rate cutting now? So people are kind of trying to figure out what's going on.
Right now I'm hearing a lot of, well, if the rates are lower, is that going to change the price of my property? And what I like to explain to these potential sellers is that, if the rate's lower, which I don't necessarily think is going to happen right away, I don't know how much of an effect it would have on your property because you do still own in New York City where there is a lot of regulation. I feel like every other month there's a new law that landlords have to keep up with. So I would say that's something you also have to grapple with as well, and that's what I've been hearing a lot of. But I'm also hearing a lot of people who are very interested in buying. They want to know what is going on in the market. How could I get in on this deal? Where could I find the right deal? So it's a lot of optimism, actually, since, the election and the new year. And I am really looking forward to seeing what 2025 has in store for us. And, I'm very excited to continue to do these reports and get these out to everyone so they could have this information. And I'd really like to thank you for joining us. And thanks to LMC Media Studios for hosting us today. To download the full investment sales market report for Bronx and Northern Manhattan, visit rmfriedland.com or reach out to us directly at RM Friedland Commercial Real Estate at 914-968-8500.
Thank you.
Thank you.